In 1944, while World War II was still raging, representatives from 44 countries gathered in a quiet resort town in New Hampshire. The meeting would shape the future of global finance. Their goal was simple: to build a financial system that would prevent another global economic collapse like the Great Depression. Out of that meeting came two institutions that would eventually become extremely powerful: the World Bank and the International Monetary Fund, also known as the IMF. At first, the IMF appeared to have a straightforward purpose. It would stabilize currencies, it would help countries maintain exchange rates, and it would provide temporary loans to nations facing financial crises. But over time, the role of the IMF expanded far beyond those original goals. Today, the IMF is one of the most influential financial institutions on Earth. When countries face economic collapse, they turn to the IMF for help. When governments run out of money, they turn to the IMF for emergency loans. When currencies crash or debt spirals out of control, the IMF often becomes the lender of last resort. But these loans rarely come without conditions. And those conditions can reshape entire economies. Because when the IMF steps in, it does not simply provide money. It often requires governments to implement major economic changes in return. These policies can include reducing government spending, increasing taxes, privatizing state industries, and restructuring entire financial systems. In theory, these reforms are meant to stabilize economies and restore financial discipline. But in practice, they often place enormous pressure on the populations of struggling countries. To understand how powerful the IMF has become, consider this: more than 190 countries are members of the organization. And when financial crises hit emerging economies, the IMF frequently becomes the central authority guiding the response. In many cases, IMF programs determine how governments restructure their budgets, how they manage their currencies, and how they repay international creditors. This influence has led critics to argue that the IMF does more than simply stabilize economies. They argue that it shapes the policies of nations themselves. And because the IMF is heavily influenced by the largest economies in the world, its decisions often reflect the priorities of global financial powers. At the center of that influence is the United States, because within the IMF voting structure, power is distributed based on financial contributions. Countries that contribute more money to the institution receive more voting power, and the United States remains the largest contributor. This gives it significant influence over major decisions within the organization, which means that when the IMF designs financial rescue programs, the interests of major global creditors often play a major role. And that is where the controversy surrounding the IMF begins, because the institution that was originally designed to stabilize the global economy now sits at the intersection of finance, politics, and international power. But to understand why the IMF has become so controversial, we need to examine how its rescue programs actually work. Because when the IMF arrives in a country facing crisis, the consequences often reach far beyond financial markets. When a country faces a financial crisis, the first sign is usually a currency collapse. Investors lose confidence. Capital flows out of the country. Foreign reserves begin to disappear. Soon the government can no longer support its currency or pay its international debts. At that moment, leaders often turn to the IMF. The organization steps in with emergency financing designed to stabilize the situation. But these loans are not unconditional. In exchange for financial support, countries must agree to a set of economic reforms known as structural adjustment programs. Now, these programs are designed to restore fiscal discipline and rebuild investor confidence, but the reforms can be dramatic. Governments may be required to reduce public spending, subsidies may be eliminated, state-owned companies may be privatized, trade barriers may be lowered, taxes may be increased, and currency values may be allowed to float freely in global markets. From the perspective of the IMF, these policies are necessary. They are intended to correct economic imbalances and prevent governments from continuing unsustainable spending. But for the populations living through these reforms, the transition can be extremely painful. Cuts to public spending often affect healthcare, education, and social programs. Privatization can shift public assets into private hands, and currency devaluations can rapidly increase the cost of imported goods. As a result, IMF programs often spark intense political debate. Supporters argue that these reforms are necessary to restore stability and prevent deeper economic collapse. Critics argue that they prioritize the interests of international lenders over the well-being of local populations. Throughout the late 20th century, IMF programs became central to financial crises across Latin America, Asia, and Eastern Europe. In the 1980s, many Latin American countries faced massive debt burdens. The IMF stepped in with stabilization programs that required major economic restructuring. In the late 1990s, the Asian financial crisis triggered IMF interventions across several rapidly growing economies. Again, governments were required to implement sweeping reforms in exchange for financial support. These crises revealed both the power and the limitations of the IMF. On one hand, the institution provided critical financing during moments of severe instability. On the other hand, the policies it required often generated social and political backlash. And yet, despite the controversy, the IMF remains one of the central pillars of the global financial system. Because when financial markets collapse and governments run out of options, there are very few institutions capable of mobilizing the resources needed to stabilize entire economies. But as global debt levels continue to rise and financial crises become more complex, the role of the IMF is evolving once again. And the question many economists now ask is whether the institution designed to stabilize the global system can continue to perform that role in an era of unprecedented debt and financial interconnectedness. Today, the global economy faces challenges that are larger than those that existed when the IMF was created. Global debt has reached levels that would have been unimaginable in the mid-20th century. Governments, corporations, and households around the world have accumulated trillions of dollars in obligations. Financial markets are deeply interconnected. Capital moves across borders instantly. And crises can spread faster than ever before. In this environment, the IMF continues to serve as one of the key institutions designed to maintain stability. During recent global shocks, including financial crises and the pandemic, the IMF expanded its lending programs dramatically. It provided emergency financing to dozens of countries facing economic distress. At the same time, the organization has begun exploring new tools to manage global financial risks. These include expanded lending facilities, coordinated debt restructuring programs, and international cooperation between central banks. But the fundamental tensions surrounding the IMF remain. Supporters see it as an essential institution that prevents financial crises from spiraling into global catastrophes. Critics argue that its policies sometimes deepen economic hardship and reinforce global financial hierarchies. In reality, the IMF exists at the intersection of economic necessity and political power. Its decisions affect currencies, governments, and millions of people across the world. And as the global financial system continues to evolve, the role of institutions like the IMF may become even more important. Because in a world built on debt, liquidity, and international capital flows, the institutions that manage financial crises hold enormous influence. Understanding how these institutions operate is essential for understanding the modern global economy. Because behind every currency crisis, behind every sovereign debt restructuring, and behind many of the most important financial decisions affecting entire nations, there is often a familiar presence, an institution created decades ago to stabilize the world economy, an institution that still shapes the financial landscape today, the International Monetary Fund.